Hi, this is AJ speaking. Today I wanted to walk you through my Tesla 4Q 2024 EPS estimates. This will be probably a series of videos because it's going to be very long. I go into an excruciating amount of detail. So buckle up, get a drink, some snack. This is going to be a very, very deep dive. So let's dive right in. So this is a financial summary of some of the key metrics, not all of them, but it gives you a good idea. We look at the forecasted 4Q, but we also compare it with the prior quarter and also last year's 4Q. So the YOY is year on year. So this compares the forecasted 4Q with the 4Q of 2023, and the Q on Q is a quarter on quarter, compares the forecasted 4Q with the 3Q of 2024. You can see the year on year looks very, very strong. You can see a lot of green colors, not too much that goes into the direction of red color. There are some negatives, and we talk about them in a lot of detail later. The Q on Q also looks good. Tesla improved in many key metrics. For example, let's talk about the main number right up front. So my EPS estimate, and this is important, is a non-GAAP diluted number. This is the primary EPS you want to look at. Looking at the other EPS is not very useful from a valuation perspective. And what you can see is that I forecast that Tesla will be growing EPS by over 7% year on year and almost 6.6% Q on Q. Let me just do one quick change to my pointer. Okay, good. So it's an improvement. However, compared to my October my 4Q 2024 estimate issued on October, this came down quite a bit, and we will discuss in great detail why it came down quite a bit. But real quick, high level, at the time, I assumed 515K deliveries for 4Q. Basically, I was using Elon's guidance. So Tesla came in around about 20,000 units below that, so that had a material impact on that number. But on top of that, the product mix was not as good as I had anticipated, and this had to do with Cybertruck sales growing slower than I had anticipated. But again, we talk about this in great detail much later. Let's just look at some of the other key metrics. You can see here in terms of revenue, Q on Q, everything is up. Energy is up massively. The gross profit, very important metric, is up for energy and storage and service and other, but down for automotive. Then OPEX, so basically Tesla's, let's call it fixed cost basis, is largely flat. And we also go into detail about that. Operating profit is down a tiny bit, so but you can call it's flat, and profit before tax is up. So this is an important point here. So between operating profit and profit before tax, there is non-operating items, and we discuss later why there is this time a meaningful difference. And then we get to EPS, as we already discussed. Free cash flow is up, almost 100 million, or let's call it 90 million. Also good, still very strong cash flow. I analyze global automotive companies, and this certainly ranks amongst the strongest cash flow numbers we have seen, and ultimately cash flow is the key metric. Yes, EPS is extremely important for valuation, but ultimately in terms of health and also in terms of long-term valuation, free cash flow is the ultimate metric. And then when we look at the whole picture in terms of margins, I expect, no, it's the wrong way to put it. My model is entirely bottom up, so I don't use really any margin for very few selected cases. But bottom line is these margins that you see, these are outputs, they're not inputs. And basically the right way to talk about this is that based on my assumptions, the result of the modeling delivers a 18.8% gross margin, and this splits into 18.3% margin in automotive, 28% margin in energy and storage. So you can see I expect a sequential decline, and we'll discuss about that, why that is later. And then service and other, I assume not again wrong, as the model implies a slight tiny improvement Q on Q, but it's really not that much. And overall, that gets us to a still very good operating margin of 10.2, slightly lower than 3Q, but there are various reasons for that, and we'll go into. So this is sort of the high level picture. If you're really not interested in sort of the details, how all this about the key assumptions, etc., you can basically stop now. Otherwise, we dive right into. So let's start with the reported deliveries numbers. Tesla reported 496,000 deliveries. This implies 2% year-on-year growth, 7% sequential growth. Here you have the numbers for all the prior quarters. This gets us to just under 1.79 million vehicles. This implies a decrease of 1.1%. So the primary reason why Tesla could not beat 2023 is actually 1Q. 1Q was filled with various logistical issues, and due to Tesla's delivery strategy, um, there was a significant all-time biggest miss ever in Tesla's deliveries, and Tesla struggled to make up for that very bad quarter throughout the year. They still did very well in 4Q, all-time high, etc. But still was enough to compensate. Bigger picture, I think this is really, in my book, a non-needle, a nothing burger, because Tesla at over 1 trillion in market cap cannot be about auto. The auto business is simply not high margin enough to get anywhere close to that. So you should not be investing in Tesla for the auto business, that's for sure. But the interesting piece about Tesla, obviously, is the AI product future and various other software products. And just on how to read these slides, here on the right side, I break down sort of the key statements. So here, this is a income statement driver, and I mark here always in these red dashed boxes the income statement line item that is most touched by that item. And here this would be automotive sales, obviously. Later this will change into balance sheet and also cash flow statement. So you always have sort of the big sort of the technical or accounting view also right in front of you as we go through these items. So then let's move on to the next item. So this looks at how these sales actually were driven in 4Q. And China was the clear driver of the sequential increase in sales. China did extremely well. It's about 18,000 incremental sales. Europe added approximately 3,000 sales. I use the squiggly line here because as of running this analysis, there can be some slight movements in these numbers, so don't take this as definitive. On top of that, we never really get ultimate US sales exact. So anyone who shows the exact US sales and not telling you it's an estimate is kind of lying to you, because we do not have the exact. So it's always a game of trying to back out these numbers. Some people try to use wins, but there are various issues attached to that methodology I explained before. So, but long story short, this is fairly accurate, but it's not precise. There can be a few thousand units difference, but it gives you a ballpark, an idea what is driving Tesla's deliveries and what are the key markets. And here this is 3Q totals, and this the increment. In 3Q, we got 463,000 sales, moved to 496,000. These were all the increments in the main regions, and you can see already that China is by far the biggest market in terms of units, and US second, obviously. Europe ranks two, but it's Europe ranks third, but it's kind of a distant third, and then the rest of the world is just above half of the distant third, which shows you that it's really a game of China, US, Europe to some degree, and the rest of the world is not really that much of a needle mover. So that's kind of sort of the key takeaway from this slide. Then we move on. On this slide, we look at the main automotive product lines. So Tesla gives us only deliveries for the Model 3 Y line. It's combined, and then what they call the other models, which includes the SX and the Cybertruck. And when you do financial modeling, you want to align your modeling with the disclosure of the company, because that avoids a lot of tons of assumptions, and this is why I break it out this way. But we will later try to break it out a little further. But high level, you see the vast majority of the sales obviously comes from the 3 and Y product line, 472,000 sales. There's a reported number, plus 24,000 other models. And here you see already some of the, I don't want to use the word disappointment, but Tesla came in below expectation definitely. So in in the third quarter, Tesla already had other models of 23,000, and so there was only 1,000 unit sequential increase. Will talk about why that probably was in a later part of this presentation. And this basically gets us to the total of 496,000. Then we move on. So now we are looking at the first bit that it's explaining to a significant degree why my estimate came down from October. So Tesla was already running quite material um, incentives in 3Q, and this then drove about the $700 in thousands shown this unit here, $700 sequential decrease in average selling prices. Everything considered, mix, pricing, yada yada yada. But then Tesla really stepped up in terms of additional incentives. There were even wider rollout in 0% financing. 0% financing is not cost free. It's basically a subsidized rate by Tesla, and the way it works then is the cost of providing 0% financing, for which Tesla actually has to pay some interest, is taken out directly from the revenue of that vehicle sale via that attractive financing offer. So the vehicle revenue is lower of such vehicle sales. So that's point one. The second point that was very important in this quarter, my average selling price dropped a lot, is because the leasing share, so the percent of vehicles sold via leasing, and this is a number Tesla discloses as part of the deliveries disclosure, spiked up massively. This was the largest leasing share in well over a year, and we look at this later in detail. This has also a dilutive effect because a leasing sale is fundamentally less attractive in the quarter of the sale, as some of the revenue basically accrues to the company over several subsequent quarters. So further out, there's some additional benefit from these sales in for Tesla, but in the quarter of the sale, it actually dilutes the average selling price, and this was another big driver. On top of that, Tesla had this very um, uh, let's call it what it is, expensive referral offer. Also, but to a much smaller degree, the cost of extending lifetime free supercharging. Tesla has to create a provision for that. That is being taken out of the revenue. So there's a lot of stuff, and then last but not least, there is you saw this earlier, and that's why I showed it to you. China's contribution is increasing, and the average selling price in China is simply lower than what it is in the US, the other large market, or in Europe, and for that reason, you have this larger contribution of these lower average selling price China sales, and this in addition further dilutes the average selling price. So basically, you have all these dilutive factors, and for that reason, if you add everything up, I anticipate a quite significant additional drop compared to 3Q. And this is actually if you boil it down to one driver, this is the main driver of sort of the EPS decrease. Tesla clearly stated, and I put here some quotes made by the CFO from the October earnings call for 3Q. And the key focus of Tesla is really growing volume, and there are sound, strategic, long-term reasons. So people shouldn't overly obsess about one quarter, is what I always advise, because this is ultimately the right strategy. So then we move on. So on this slide, we look at what this actually means in terms of revenue when you take into consideration the volume, the 496,000, plus the drop in average selling price. And the net result, and important to note here, this is before leasing sales and before credits. there's a small sequential increase in revenues. So if you just look at deliveries, you expect much more, but the drop in average selling price offsets a lot of the increase, and that's why there's a relatively modest increase in automotive sales, excluding leasing and credits. And here again, this is still in the same part of the income statement. Then we can move on. So this slide is exactly the same slide as just before, but this time we split it into the different product lines, and you can see that the 3 and Y line contribute 17.1 billion to the 19.0 billion expected. So the vast majority of the automotive revenue really comes from just this product line, and this is important to keep in mind. This is why the model refresh, which accounts for the majority of this number, is so interesting. That the Model Y is by automotive standards a quite old vehicle now. Now, of course, Tesla continuously upgraded the interior, sort of what's under the skin, made the software better, added better components, etc. But it still looks like 5 years ago. That's a big problem in automotive sales. So this is why the upcoming refresh is very exciting and will drive sales and more, and also importantly, as I said, in the first few quarters, it should improve mix, as we saw at the time of the original, of the first gen Model Y launch. There was a much better mix. A lot of people were buying performance models, etc. We can expect something similar to happen in 2025. Cybertruck, um, Cybertruck revenue didn't increase as much as I thought in October, and it's partly due because volume was significantly lower than what I had expected. Plus, Tesla started selling more lower priced Cybertrucks that has had an impact. And then I also anticipate a further decrease in S and X sales, a further cannibalization. So it seems like the S and X, we have not yet bottomed in terms of S and X sales, but frankly, we have now reached such a low level. It doesn't really matter anyways at this point, because SX sales revenue has become so small, and given the overall size of Tesla's business. So then we move on. So on this slide, we look at the components of the average selling price. We discussed before it dropped quite a bit, but now let's look at why it dropped so much. Here you can see a Tesla unlocked in 4Q, a lower Cybertruck options, and this is still higher than the entry level selling price, and this is because of mix. There's still people buying the higher trim, and you know that there are some other sales associated with vehicle sales, you know, winter tires and things like that. So you have a significantly higher average selling price. Model S and X sales also decrease, also in part due to increased purchase incentives of different kinds. Then here you have the key one, Model 3 Y product line, drops for the first time below $39,000 to what I expect to be around $38,200. And this then, when you volume weight, or I should say revenue weight, versus the vehicle volumes, the volume weight, the correctly calculated number is then 40.4 thousand, which is the number you saw on the prior slide. Then we can move on. So now we moved a bit further in the P&L. So now we moved out of automotive sales into automotive regulatory credits. So people who follow Tesla are probably familiar with this item. Tesla earns regulatory credits for selling zero emissions vehicles. This is a important earnings driver. Here you can see last quarter, Tesla sold 730, or actually no, sold is the wrong word. Tesla recognized 739 million. This looks low given its revenue, but you have to keep in mind this is revenue that is pure profit. So you have to kind of 7x this number to get like an auto revenue equivalent. So this is a very important metric. There is obviously a big debate about whether Trump will eliminate credits in the industry, but I would like to remind everyone, this would be in an effort to cut back on subsidies in general, and you cannot think about this just in terms of EVs, because there are also various ICE subsidies. So you have to think about this more holistically. So if Trump really kills the this credit, and then of course we have to consider the timing of it. How quickly will this happen? There's of course one event is the announcement, but then it has to go through the legal machine to put this in place. So there could be probably at least a few quarters till this actually becomes effective. And then strategically, a big picture, what you have to keep in mind as an investor, with every passing day, Tesla's AI products become better, get closer to actually launch. And with every passing day, these things, automotive sales, regulatory credits from automotive, all these things become less and less important because, yet again, the Tesla investment thesis cannot be about auto sales, cannot be about regulatory credits. So this was part one of my video series. The video is already around about 20 minutes. I have to cut it off here, otherwise it just gets too long. And yeah. So I see you in the next episode. See you later.